Hey guys, welcome back. In this video, I want to finish up my thoughts on the Q3 earnings from AMC. In yesterday's video, I went through updates to the spreadsheet model to account for the new information we have now that we know the new debt deal. In this video, I'm going to talk about a couple of things from the Q3 earnings. Not going to go through all the numbers, don't worry. You've probably already seen them, but I want to talk about three main things and a little bit of wrap up. And those three things are: why was there a loss for Q3? Where did the cash go? What is the new hurdle for box office for AMC to be profitable in a quarter, or at least break even? Is there anything positive that we can say about the Q3 results? And finally, what concerns do I have going forward? I'm gonna try and keep it quick. Let's get right into the info. The first thing that I want to talk about is the net loss. It was a 20.7 million net loss for the quarter. I talked about some of that in the previous video. Let's just wrap it up in one or two sentences right now for those of you that did not watch that other video. And then please go watch it. AMC should have been profitable in Q3 based on all the previous data we had at this box office level. But there are two key things that I see in the income statement that caused them to go into the negative this quarter. And that was the operating expense. And the second item was the corporate borrowings, or the interest expense that the company pays on its debt every quarter. If we look at the OpEx as a percentage of total revenue, which is what I do every quarter, it should have been in the neighborhood of around 32%. It came in at 33.7%. Back in Q3 of 2023, when we had similar size box office, the OpEx was 31.99% of total revenue. In Q2 of 2023, similar box office, it was only 30.57%. So having that OpEx increase to 33.7% was not something that we were expecting. Sometimes these things just happen. That's what makes forecasting an inexact art. And when these things do happen, the company usually puts a footnote in the 10Q, which they did, to explain why the OpEx was higher. And they say that it was primarily due to increases in equipment expense, premium format expense, and insurance. The other item that increased due to the new debt deal was the interest expense for the quarter, $109 million, because of that new higher interest rate on the term loan. And you can see in orange here, all of the quarters to the right in the past, we have a long history of the quarterly interest payment being around $89 to $90 million a quarter. Now it is $109 million. The net result was the $20 million loss, negative 6 cents per share. If I change the OpEx to something more in line with a year ago, 32%, say $431 million, and I drop the corporate borrowings to what it has previously been every quarter before now, $89 million, all of a sudden you can see we had a positive 6 cents. So these were the two buckets that caused AMC to have a loss for this quarter. Hopefully that makes sense, and I have updated, as I said in my video yesterday, the spreadsheet model to account for these new higher costs. And maybe AMC hopefully can get the OpEx in line going forward. But the corporate borrowings, unfortunately, is a new number that we're going to have to deal with every quarter. $109 million, $20 million more per quarter than it used to be, thanks to the new debt deal. The second thing to touch on real quick is, where did the cash go? We know last quarter AMC finished with $770 million on the balance sheet. In Q3, they ended the quarter with $527 million on the balance sheet. Where did the money go? It's never a secret or a conspiracy. Where did the money go? Everything is documented and accounted for in the 10Q. Go to the cash flow statement and you can see exactly where the cash went. We have three buckets on a cash flow statement. Operating cash flow, so they spent $31 million, 31.5 supporting the operations. You have the investing cash flow bucket, that is bucket number 2, $60.5 million spent mostly on CapEx, improving the business and general maintenance of the properties. And the third bucket is the financing cash flow, $155 million spent mostly to repay some of the debt during the quarter, or money spent in the business of refinancing some of that debt, paying off some of the 1012 PIK toggle, some of the other notes that the company had, processing fees, transaction fees, paying off the debt, everything together, $155 million. The details of all of that is in the 10Q. They walk you through all of that. We're not going to do that here, but if you're curious, go to the 10Q, read the management notes. They explain how all of this money got spent. The net result was the company spent $241 million. That is our net cash flow, a negative $241 million. That negative on the cash flow statement explains the difference from quarter to quarter on the cash on the balance sheet. I want to talk about the new debt deal and that higher interest payment that we're going to have to deal with going forward, and how that affects my spreadsheet model and the amount of box office that the company is going to need to break even or generate a profit. As you can see in the left-hand box there, in Q2 of 2023, we had almost the same domestic box office, 2.68 billion. And during that quarter, AMC's admissions revenue came in at 28% of that domestic box office, and we booked a profit that quarter. So what happened this quarter? I just explained that to you in the beginning of this video, the OpEx and the corporate borrowings. If we set aside the OpEx for a second and just think about the corporate borrowings, because that is going to be there no matter what, there are some new hurdles in terms of higher box office the company is now going to need to achieve based on my spreadsheet model to break even at a 28% number instead of 2.68 billion now, or 2.66. You can see on the right hand box that by my spreadsheet now it's going to be a little bit higher, $2.77 billion to break even, because the interest expense per quarter went up $20 million. Obviously, if AMC captures a greater percentage of the market share, then you need a little bit lower box office, and that is what this box on the right-hand side of the slide is attempting to communicate to you. So if you hear AMC talking about market share, i.e. the GO plan, and we'll talk about that in the next video, when they're focused on market share, they want to capture as much of the market as they can because it makes them more profitable even at a lower box office. So you might be asking, is there anything positive you can talk about? What is management doing to improve things at AMC? And I track, for one, the number of theaters and screens that the company has in the fleet. And you can see on the left-hand side of the screen here, they have dropped the number of theaters owned as long-term leases finish up, and they eliminate theaters which are going to be too expensive to renovate or ones that are non-profitable. The number of theaters has been decreased by the work of management from 1,001 theaters all the way down now to 874 theaters, and that is shown here on the chart also. The red line is the number of screens and the blue line is the number of theaters. By eliminating these theaters, the company just on rent has booked over $100 million of savings per year, money that's not being spent on rent. And then you add in maintenance, insurance, staffing, utilities. The savings are much higher than just the savings on rent alone. And I haven't calculated all of the other savings related to the theater closures, but I think you see where I'm going with that. And I think it is worth pointing out that as they're doing these closures, the revenue is still going up. So they are getting more efficient, trimming costs and rent and the related expenses that go with those theaters not being in the fleet anymore, and still growing the revenue. The other thing that's worth checking in on from time to time is how is management doing at attacking the debt? And yes, I realize that paying off this debt is coming at the expense of shareholders who are providing the capital for that. That is for you guys to decide if you wish to stay invested in the company and participate in that or not. That is not what this discussion is about. This discussion is management doing anything? Because I see people on social media all the time still saying none of the debt has been paid off. And so we have all of the debt from the company tracked here on this table and represented on the line chart here, we can see that the total debt, including the lease liabilities, at its peak in 2020 was almost $12.5 billion. It is now $7.8 billion. And if we just look at the corporate borrowings, the money that the company borrowed, not counting the lease liabilities, $5.8 billion at the peak and currently at $4 billion. So $1.8 billion of corporate debt has been paid off. And then they have been doing all of the other work to restructure it from 2026 and give themselves to 2029 or 2030. And hopefully the box office is better, company's cash flow is better, and they can, in that process, get a better credit rating and get even better interest rate on this debt and continue to attack it. But the debt is going to be here for a while. We just want to see that they are making progress reducing that debt and fixing that balance sheet. And if you listen to what they say and you read the 10Q, repairing the balance sheet is one of their primary objectives, and they have been executing on that objective. What concerns do I have going forward? Mostly they center around dilution, and I know that is an uncomfortable topic for people, but all of the clues are there if you are paying attention. Adam talked about it in the earnings call. He said, cash is king, and as we move forward, we will continue to take actions as needed to keep our cash reserves robust and to lessen our debt. In addition, there are multiple places in the 10Q that tell you there could be more dilution. I know most of y'all expect it, but some of you are just in complete denial. There is going to be more dilution, without a doubt. The company has told you for the last 4 years that fixing the balance sheet is a strategic priority, and until they're profitable, there's only one other way to get money, and that is through raising money with ATM offerings or paying off the debt with debt for equity swaps. Either way, both of those are considered dilutive events. That is not crime. That is not a corrupt CEO. He's not trying to punish you. He's not trying to help the shorts. John Goodman, the CFO, has one job, and that is to repair the balance sheet and to get the company a better credit rating. And they are going to continue to take every step they can as long as you're willing to provide them money to repair that balance sheet and get the company on a strong footing while the industry is recovering. Again, it is up to you to read the 10Qs, read the risk factors, and decide if you want to participate along with that or not. That's not for me to tell you what to do. You go do your own reading and you make up your own mind. Those are the thoughts that I wanted to share with you about the Q3 earnings and where we're at right now. Q4, I'm expecting the box office is going to get really exciting here between now and the end of the year. But you now know what the box office needs to be at if you were paying attention for the company to break even or make a profit. So keep an eye on that. And you also know about my concern about dilution, and you can make up your own mind if that's something that you're worried about or not. If you have any questions or comments, please drop them for me down below. Thank you for watching all the way through. I hope you learned something from this video. I am Tony Denaro, and I will see you on the next video.